Hello everyone, welcome to today's US Open live webinar. It is Thursday, April the 20th, 10 minutes before Wall Street opens. As always, I am your host, Nikos Zabouras, Senior Market Specialist at FXCM. So, quite a few things to talk about. Obviously, in the spotlight are the earnings results by Netflix and by Tesla. Significant takeaways there from the streaming giant and the electric vehicle leader. And of course, other than that, markets focused mostly on inflation figures from the UK, which were hotter than expected, and Eurozone as well, and also today from New Zealand. So that's what we will be talking about in today's US Open. But before we begin, as always, please read carefully through the disclaimers and the risk warnings. Once again, please go carefully over the investment warning and the risk disclaimers. And also please note that anything discussed in this webinar does not constitute investment advice and should not be construed as such. Okay, let's get the ball rolling. We have quite a few developments to cover. We have the New Zealand dollars against the US dollar on our screen. Before we move into that, let's start from UK inflation, which was released on Wednesday. And it actually, CPI, headline CPI, eased a bit in March, but stayed above 10% for the seventh straight month. Reinforcing the likelihood of further tightening by the Bank of England at the upcoming meeting. While on the euro area side, headline inflation decelerated sharply, but the core, which excludes energy and food prices, ticked up, which shows that essentially any work the ECB had done has not yet been reflected, let's say. And that's also a familiar pattern, not only for Eurozone, headline figures going down, core readings remaining sticky. Of course, along with hawkish ECB and Fed commentary, those data reignited inflation fear, recession worries, and prospects of tighter monetary policy by the central banks. Well, just earlier today, we got an increase in jobless claims in the United States, which presses the greenback at this point. Now, of course, now looking at NZD USD, earlier today we got the quarterly inflation figures from New Zealand. What they showed was a significant deceleration of CPI in Q1. Year over year was 6.7% from 7.2% in the previous quarter. That's the lowest since Q4 2021. Now we know that the Central Bank of New Zealand is very hawkish and delivered another rate hike in its last meeting. Was a bit vague about how far it will go, but based on its latest available projections, we would expect another rate hike at the next meeting. Now we have seen, however, also some hawkish commentary from the Fed, which creates a little bit of a mixed picture around the policy differential. Now, in any case, the kiwi was pressured from the inflation release, and this puts immediate bias on the downside and keeps the 2023 lows in the spotlight and the region of 0.60856059 down here. But on the other hand, we see that it tries to react. You can see how it's finding support after the initial reaction lower, and we can see an effort to retake the 200 period EMA, the black line that we highlight here. Now, daily closes above it would shift immediate bias back on the upside, but we can also see that it's not, the upside is not particularly friendly. We have the daily Ichimoku cloud, and we also have the April highs over here at 0.6383. Although we can see it above the exponential moving average, we would need a significant improvement in sentiment for further gains. So that's it with NZD-USD. Let's move over to Euro-USD, which is typically where we begin from. We will also talk about the earnings reports from Tesla and Netflix that we already mentioned, but we will do it in a little bit once we get to the Nasdaq analysis. So Euro-USD, the truth is that nothing has changed from what we have talked about over our previous sessions. Markets digest monetary policy outlook, which remains supportive. The ECB is far more hawkish. We have seen this week as well aggressive commentary about the need for more tightening. On the other hand, of course, we have also seen the Fed being a little bit more hawkish than compared to the recent dovish shift. There, the question is not so much about the size of the next move, which at this stage a bit penciled in to a 1/4 percentage point, but how long we will stay there. Markets are quite optimistic, but the Fed has ruled out any cuts within the year and has pushed this higher for longer narrative. Now, we have seen after the 2023 highs a correction, a limited correction that creates risk for a breach of the exponential moving average, the 200 hours, the 200 period, sorry, exponential moving average. But we would need to see strong catalysts for further declines, and mainly this region here with the ascending trend line and the 200 days exponential moving average to move below that level, again because the policy outlook is more favorable for the common currency. And of course, the euro is in the driver's seat, can set new 2023 highs, although 1.1233, the next major resistance, looks a bit distant at this point. Now let's move over to the Nasdaq and also talk a little bit about the earnings from the two big tech companies that we discussed. We're still a minute out of the US Open. So let's start with Netflix. Tuesday after Wall Street close, reported solid financial results in line with its projections, but they were far from impressive. And the company spoke of a good start in 2023. However, the addition of just 1.5 million users in Q1 was disappointing and a far cry from the 7.66 million members it added in the Q4. It also delayed a broader crackdown on password sharing and said that it is pleased with the recently introduced ad-supported tier. having seen little switching, that's a key point, little switching from the more expensive advertisement-free subscription plans. Now, of course, both for Netflix and Tesla, we have written extensive reviews of the results. You can find them on the FXCM market analysis websites of your respective regions. Now, around Tesla, profit slumped. Tesla reported overnight. Tesla profits slumped due to the multiple price cuts. Net income decreased by 24.4% year over year. And by more than 30% compared to the previous quarter. Gross margins dropped below 20% for the first time in over 2 years, marking a decline in both quarterly and sequential basis, and operating margins were also squeezed to 11.4%. Now, another key point here was the fact that the company determined that the best strategy is to prioritize higher production level over higher margins, according to CEO Elon Musk in his comments on the relevant earnings call. Again, you can find in-depth analysis for both Tesla and Netflix on your the FXM website of your respective regions. Netflix dropped yesterday after the results, and in pre-market, Tesla was also losing around 8%. Now, looking at the Nasdaq, again, not much going on compared to what we have previously mentioned. You can see this consolidation phase over the past several days, and that creates scope for further decline towards exponential moving average in the broader 12,300 region. But actually, we're sorry, this is the 12,800 region, but further declines towards this region here around 12,300 would need a strong catalyst. Bulls are definitely in the driver's seat, have the ability to push higher, but don't inspire much confidence for actually taking out or challenging the next major resistance at 13,724. Now, coming up, we have Japan CPI inflation. Ex-fresh food had dropped to 3.1%, had actually decelerated sharply to 3.1% in the prior month, which is the smallest increase since September. This will likely help the Bank of Japan to maintain its ultra-loose policy setting, and the new governor in any case has not shown any intention to rock the boat. However, even small changes towards normalizations can create big market impact, as we also saw in December when the BOJ tweaked the yield curve. Other than that, we also have a series of preliminary PMIs from various countries and regions, as well as retail sales from Canada and the UK, all of that on Friday. So that's it from us for today. We will talk again at our usual day on Tuesday and usual time, 10 minutes before Wall Street opens. Thank you for joining me.